Hi, welcome to another episode of Hatch Online today. We have Rajitha Rordigo, Managing Director of WR Rodrigo and Company, Chartered Accountants. To give you a brief intro about Rajitha, he has 15 years of experience in finance and taxation. He is an associate member of the Institute of Chartered Accountants of Sri Lanka and an associate member of Chartered Institute of Management Accountants UK, and also an associate member of Certified Practicing Accountant of Australia. WR Rodrigo and Company has been serving more than 1,000 clients for nearly 35 years, from sole proprietor businesses to quoted public companies in Sri Lanka. We are glad to have you at Hatch Online today, Rajitha. Over to you to discuss about the optimizing your wealth through efficient tax planning.
Thank you very much, Sashmi, for that introduction. So good evening to everybody, and thank you very much. First of all, I would like to thank the management of the Hatch to providing this opportunity to provide the knowledge and share the experience with you in order to optimize your wealth through a better and efficient tax planning. So first of all, I think I will share my screen first in order to start the presentation. So you will, after having the presentation, we will be having the Q&A session. Then during that session, you can ask whatever the question you have related to the tax planning and whatever the tax recent changes happened recently. So I will share the screen right now. So I think we need to get a sort of understanding on the tax structure of the Sri Lanka, which is before the 31st December 2019, because a recent amendments happened from the 1st of January 2020. So from before that, we need to understand what are our revenue sources and on which revenue sources the tax is going to be calculated. So basically, I think from 1st of January 2020, and you heard that if you have a employment income more than 250,000 per month, it means you'll have to open up a income tax file and you have to start paying taxes. So before, apart from the employment income, you have any other revenue sources as well, like the dividend income, interest income, rent income, consultancy income, and business income. So prior to 31st December 2019, I think we need to understand what was the tax calculation, how the tax calculation happened, and what is the recent tax amendments happened from the 1st of January 2020. So if you have any these kind of revenue sources, yes, if you have the revenue sources are more than, if you calculate the revenue sources, if it is more than 250,000 per month, it means you need to open up an income tax file and you have to calculate your tax liability and you have to pay with the Inner Revenue Department. So I think you can get a sort of understanding. Everybody know what is your employment income, that is your salaries and all other benefits. And dividend income is whatever the dividend income you are getting from the shareholding, which is in the quota public company or any other non-quota public companies as well. So interest income is definitely related to the fixed deposits or any other instruments which are within the banks and the financial institutions. And the rent income definitely related to the whatever the real estate you have been rented out to any other parties, third parties. From that you will earn a rent income. So there are a lot of employees or any other individuals, actually especially individuals, they must be having any other consultancy income as well. So basically professionals, they must be having other consultancy income as well. And apart from that, if you have any other business income, if you have any business apart from your salary, if you have engaged in another business, if you getting a sort of revenue out of the business, then it will be taken under business income. So we go after that, we need to understand what we call is year of assessment. So it's similar to the financial year as well, where we are going to start of April 2019, and till the 31st March 2020. This is how normally the financial year is. The same applicable for the assessment under the Internal Revenue Act. So, but one thing you need to understand is that in 2019 and 20, that due to this change, the period actually divided into 9 months and 3 months. Because from 1st of April to 31st December 2019, it was applicable for the previous tax regulations. But after the change from the 1st of January 2020, for the last quarter, over the 3 months from the 1st of January to 31st March 2020, actually it's all the new tax regulations. So because of that, normally in a year of assessment, we normally take from 1st of April to 31st March. But from these recent tax changes happen, now the period has been divided because the calculation will be different. So in here, when you are filing your income tax return for the year of assessment 2019-20, be careful. We need to get sort of a consultation from your personal tax consultant to arrive with this tax calculation will be different. Now up to now, I think Internal Revenue Department has already issued the tax guidelines for tax computation for the 9 months period and a 3 months period as well. So this is an year of assessment from 1st of April to 31st March. So what was the income tax rates prior to the 1st of January 2020? That is something we need to understand. What was the system before the 1st of January in order to understand what been changed has changed from the 1st of January. Because if we do not know what was the previous tax calculation, we will not understand what really changed in the tax structure. So previously, if you had a sort of a employment income or income, so after I think before the 31st December 2019, the employees had a tax called payee tax, pay as you earn. So that I think employee didn't have to do anything. I think employers were responsible and they had to deduct the tax from your salary and they had to remit to the Internal Revenue Department. But if you are individual taxpayer before the 31st December 2020, there was a tax in the tax calculation. There was an employment tax relief of 700,000 and the personal income tax relief of 500,000. Altogether, you are eligible for a 1.2 million tax relief. That was your previous tax relief. From whatever the revenue you are getting from those sources, once you add up all your revenue sources, so the tax relief was 1.2 million, you can deduct it, and then this was the tax rate was applicable for the up to the maximum of 24%. So you were paying 24% before the 1st of January 2020. So these were the tax rates and the tax release applicable previously. So you need to clearly understand. So in order to clearly understand, we will do a small sort of illustration to understand how was the calculation prior. So the Mr. A is a CFO of a company Q. He received the following income during the year of assessment 2019-20. The employment income is 4 million, and it has already the company has already deducted pay that is 129,000. We have interest income of 1.6 million, dividend income 150,000, and rent income of 450,000. If that person have this revenue, we will see how the calculation happened prior to the changes. So if you do your calculation, so the employment income is 4.3 million. But when it comes to interest income, dividend income, what will really happen before the 1st of January 2020? It means that during the first 9 months of the financial year. So normally, I think if you have the fixed deposit, if you have an interest income, you definitely know that from the they deduct 5% from your interest income. That is the withholding tax of 5%. And it was the final taxation. So once the bank deducted 5%, whatever the interest you earn, if the bank deducted 5%, the 5% taxation we deductors has taken the final tax. And it is as your part of assessable income. and the calculate it will not your calculation. So because of that, that's why in my presentation you can see that 1.6 million, 5% is 80,000 deducted. It has been already paid by the bank to the IRB. So yeah, the 1.6 million has not been taken into the calculation, and no dividend income. So dividend income previously it was around 14%. It's 14% withholding tax. So if you receive a dividend, the respective company that before they paying you the dividend, they have deducted 14% at withholding taxes and paid to the department. Yeah. So then first illustration is to understand, get understanding how the tax work after the change before the 1st of January 2020. So we need to get understanding in order to get understand what are the changes really after the 1st of January 2020. So this is income. I think you got an employment income, and the company has deducted the pay, interest income, dividend income, and rent income as well. So then we'll see how the calculation is going to happen. So under the previous calculations, the employment income, yes, definitely is part of your as well income. And when it comes to interest income and dividend income, is a bit different, because during the last, before the 1st of January, you had a tax called withholding tax. For interest, you had a final withholding tax of 5%. Whatever the interest you earn from the bank or any other financial institute, the bank actually deducted 5% and they have remitted to the IRD. So because of that, whatever the withholding 5% deducted has taken as the final, and it is same way the dividend income also the 14% from your dividend income by the company, and they have remitted to the IRD. So once they deducted 14%, it's your final tax. And it will not be part of your assessable income. So in your calculation, you can see that interest income 1.6 million and 150,000 dividend income has not taken to the calculation, because withholding tax already deducted and it has been taken as your final tax. Then the rent income. The rent income is part of your assessable income. Because of that, we have added 450,000. Altogether 4.8 million. So we'll see how the calculation happens. So the total assessable income is 4.8 million. From that, interest and dividend income is not part of your assessable income. So and we'll see what are the deduction you will get from the government, from the IRD Act. So you got employment relief of 700,000 and the personal relief of 500,000. That's why I mentioned in my previous slides that you are eligible for 1.2 million income tax allowance. And also for the rent income, you get a rent relief of 112 25%, 112,500. So altogether, from your total assessable income, you can deduct 1.3 million. So your taxable income is going to be 3.5. So if you calculate the tax according to the previous tax table, the total tax going to be 485,400. So you can understand. So from your revenue sources, yes, employment income is part of your assessable income. And interest income, dividend income, the already bank has deducted 5% and the company deducted 4%. It is and it is part of your assessable income. Yes, rent income is your part of assessable income. So this is the, and out of that, you got a 1.2 million tax relief and also rent relief as well. So after that, you calculate your tax liability. So this is how the previous tax calculation happened. It means prior to the 1st of January 2020, or otherwise from 1st of April 2009 to 31st December 2019. So after you get this understanding, I think now you get a sort of a understanding what really happened before. Now we'll get understand what really happened after 1st of January 2020. So for the employment income, definitely you know that you deducted, the employee deducted pay as you earn, and employer has remitted to the IRD. But from the 1st of January 2020, the government abolished the pay seal, and they introduced a tax called advanced personal income tax. So the payee actually abolished from a notice from the month of February, but there was another tax came up after the 31st March. It came in the April month. So we call it advanced personal income tax. But under the advanced personal income tax, you have two options, which is I'm going to explain you further in my presentation. And what we really need to understand here is, even though the pay is were there and it is abolished right now, but there is a new tax came which is similar to pay. I will explain how it is happened. But one thing you need to understand is, prior to 1st of January, under the pay scheme, the responsibility was with the employer. Employer has to deduct from your salary if that revenue, if your revenue was more than 100,000 rupees, the employer had to deduct the tax from you and then pay to department. If the employer has not done it, it is the responsibility of the employer. But from the 1st of January 2020, from the 1st of April 2020, APIT was introduced from the 1st of April 2020. From that day onward, the employee is the responsible person. So you need to understand very carefully. Even though the pay is abolished, but again there is a personal advanced personal income tax is there, and same way the employer can deduct and pay to the department. But now the responsibility has changed because it was previously pay. Now we call it advanced personal income tax. So you are coming under personal income tax category. So further, interest and dividend. So interest and dividend, final, previously it was final for the individuals. Whatever the 5% deducted from the interest, it was final. And whatever the 14% withholding deducted from your dividend is final. So it is not part of your assessable income. But from the 1st of January 2020, everything withholding tax was taken off. There is no withholding tax. I think even if you check your with the banks from the 1st of January 2020, they did not deduct the 5% from your interest, or they did not deduct the 14% from your dividend. Even previously, when you have a rent income, you have to the tenant has to deduct 10% and pay to the landlord. But here from the 1st of January 2020, all the withholding taxes were removed. So it is not going to be final. It is going to be part of your assessable income. And rent income, yes, it was always your part of your assessable income. Further, it will continue as part of your assessable income. Whatever the consultancy and business income was part of your assessable income, it will continue to be part of your assessable income as well. So here you need to understand, so drastic changes has happened, especially for the employment income and the interest and dividend. So pay was there. Now the pay is not pay not here now. So from the 1st of January, pay has been abolished, but the government brought back another tax called advanced personal income tax, which I'm going to explain you further. And the interest and dividend, it was the final withholding taxes, not part of assessable income prior to 1st of January. Now it is part of your assessable income. So you can get an understanding what was there previously and what has happened after the 1st of January. So we will further discuss. Okay, the question is always asking, everybody is asking is pay is abolished? Yes, from the 1st of January 2020, from the notice date for 15 February, it has been abolished. But from the 1st of April 2020, the government brought back a tax called advanced personal income tax. And also for the month of January, February and March, the employer didn't deduct the pay from your salary. So because of that, you didn't have to pay. But from the month of April, government put a notice that you have to pay for the January and March taxes. So because of that, people were in a problem, and because of that, I think government gave a sort of a concession that in the convenience of the and request of the employees, that deduction accommodated under the pay system. So whatever the January to March, which has not deducted, I think most of the employers, they got the consent from the employee, and they deducted from the month of April salary, and they paid to the department before the 15th of May 2020. I think most of the employees followed that process, but you have to keep it in mind that this is not pay. Now we call it advanced personal income tax. We will go we are try to understand what is advanced personal income tax. So it is a scheme where the employer may request the employer to deduct the taxes at the source of employment income. The department has given you two options. You have to understand this very carefully. Well, the first option is you can give the consent to the employer to deduct it from your salary and pay it to the department. Or otherwise, what the second option is, you can open up your own income tax file. You can open up your own income tax file, and then okay, if you select option 2, you can open up your own income tax file, you can do your own calculation, and you can pay the payment on quarterly basis. So if you select option 1, it means your taxes will be deducted on monthly basis. But if you select option 2, you can pay your taxes on quarterly basis after every 3 months time. So here what you need to understanding, is there any benefit between option 1 and option 2? Okay, the thing is, okay, for the option 1, so since the pay is abolished, you can't use pay tax tables from the 1st of April. You can't use it. Okay, so what is the calculation the employee is going to use? So from the 1st of January 2020, when they change the tax system, they introduced a new tax relief of 1.2 million for certain 5 expenses, and that 1.2 million was not incorporated into that calculation. So because of that, if you select option 1, you'll be ending up paying more taxes. I think paying taxes more than your liability at the end of the year. So it will, at the time of submitting your income tax return before the November 30th, you will identify that there is a refund eligible for you. So refund, according to the IRD, that refund is not going to be refunded for the next year. They're going to allow you to continue for the next financial year to set off. But the thing is, why you want to pay more taxes more than your liability? So because of that, that 1.2 million has not been incorporated into that employer's calculation. But if you select option 2, you can actually claim that 1.2 million, and then you can calculate the actual tax liability and pay your taxes on quarterly basis. So we will discuss further. I will show you in the calculation as well what is the advantage on it. So if I request employee to deduct the tax from January to March 2020, and can I avoid an income tax return? No, a return would have to be filed for the year assessment 2019-20 or no before 30th November 2020. So if you pay in taxes, even they are only employment income, it means you are paying now, not you are paying the advanced personal income tax. It means you are paying income tax. Because of that, you have to submit the return or no before 30th November. And after that, I think in the what you learned previously is advanced personal income tax. So advanced personal income tax, it is actually is similar to the scheme of the payee. One thing you need to understand is before the 1st of January 2020, there was payee. Now they have introduced APIT, Advanced Personal Income Tax. Before the 1st of January 2020, there was withholding taxes. Now they have introduced Advanced Income Tax. Advanced Income Tax. Advanced Income Tax is a scheme of fixed regular payment, requires with withholding agent to deduct taxes and pay to the department. So if you when you call fixed regular payments, we call it dividends, interest, discount charges, natural resource payment, rent and royalty likewise. So before the 1st of January, what really happened is from the interest, you have deducted 5% withholding tax. You have deducted 14% withholding tax. So now withholding is abolished. So they have taken up a new tax scheme called AIT, which is similar to the withholding tax. So it's actually, even though the withholding has been abolished, actually it is the same tax structure, but with different name. But even the responsibilities has been changed. This is something we need to understand. Previously we had payee, now we had APIT. Previously we had withholding tax, now we have AIT. So difference is that now in the advanced income tax, the problem is previously we know for the income tax, interest income, whatever the interest income you earn, whether you earn 1 million interest income or 10 million interest income, the interest rate is 5%. Withholding tax rate is 5%. That is the one. That is the rate. But when come to AIT, the banks, now the problem, there is administrative issue that the banks has to get the income tax rate from the income taxpayer. It means now the income tax rate is up to 18%, is 6%, 12% and 18%. So you need to, the income tax payer needs to give the what is my income tax rate for the bank. So it is going to be a big administrative issue for the bank. So I don't believe that the bank will take that kind of administrative task in order to take each and every call, each and every deposit holder, and they then get their income tax rate where they are going to deduct from their interest income. So now I will tell you what will be the differences as well. But the problem is, even though the AIT is there, what I believe is, even that withholding tax agents will have a very difficult time, because now there is no any certain percentage they because you need to take the different tax rate from each and every deposit holder or from a tenant. So because of that, there are a lot of administrative issues will come in. So we'll discuss further on that, so you can understand what is AIT. It is the sort of a replacement which is for the withholding tax. So payee, it is APIT, and for the withholding, it is AIT. If we move on to the next slide, okay. So we need to understand, okay, what is the qualifying payment relief? So earlier in our first calculation, you saw that you had a tax relief up to 1.2 million, 700,000 for your employment relief and 500,000 of personal relief. So total is 1.2 million. So under the new tax changes, now it has increased up to 3 million. The 1.2 has increased up to 3 million. And apart from the 3 million, the government has given you another tax relief of 1.2 million. But 1.2 million is only applicable for 5 expenses. First is health expenses, including the contribution made for the medical insurance, and also the educational expenses incurred for such individual and on behalf of your children. And if you have children, if you have spent money for their education, it can be for your school, it can be your tuition classes like that. If you can get an invoice, you can claim. And if you have any housing loan, whatever the interest you paid to the bank, you can claim it from your calculation. And whatever the contribution you made for the approved pension scheme, that contribution can be deducted from the tax. And also the expenditure incurred to capital expenditure incurred to acquire equity of security, you can claim it under this relief. So whatever the expenses you have, the maximum up to 1.2 million, you can claim it during the year. So per quarter is 300,000. So if you have any expenses and if you have the source documents, the original source documents, you can claim up to 1.2 million. So previously you had a tax relief of 1.2 million. Now that relief has increased up to 3 million. Additionally, the government has given you another 1.2 million, which is related to these 5 expenses only. So if you have any expense related to five items, you can claim it under the new relief, qualified payment relief, which is 1.2 million. So maximum is 1.2 million, but you need to have the source documents to prove that you have incurred that expenses. So you can understand, compared to the 1.2 million, now you have 3 million plus 1.2, altogether you can deduct 4.2 million from your as well income. So it's a big relief has given, the government has given to the income taxpayer. So if you check what are the total relief available for the individual, if you really check for the year of assessment 2019, 1920, for the 9 months, because we have to take it approximately. So then from 375,000 plus 500, from 500,000 rupees personal tax relief. If you take for the 9 months, it's 375,000, and from the employment relief 700,000. If you take 9 months, it's 525,000. So altogether 1.1 million, like you can claim it for the 9 months. And for the 3 months, it's based on the new tax relief. So 750,000 rupees is out of the 3 million, is for the 3 months is 750,000, and out of the 1.2 million, if you have any qualified payments, if you have incurred expenses under that 5 items, you are eligible to get 300,000. So here, that's why I'm telling you that for the year of assessment 2019-20, if you are going to calculate your income tax, for the 9 months is a different calculation, and for 3 months is a different calculation. So the department has already given the guidelines. You need to seek your advice. You need to properly study the guidelines and do your calculation, or otherwise you get the help from your personal tax consultant. So then for the 9 months, you are getting 375,000 and 525,000 as your relief. And for the 3 months is 750,000. If you have any qualified payment relief, then you can go up to 300,000 maximum for that 3 months. So for the year of assessment 2020-21, it means the current year, from the 1st of April 2020 to 31st March 2021, you are eligible to have 3 million plus 1.2 million. So 1.2 million is applicable if you have expenses related to that 5 line items. So I think, okay, if I start from the year of 2019-20, so you need to have the 9 months and 3 months. The 9 months is applicable under the previous tax structure, and the 3 months is applicable for the new tax structure. So as I explained you earlier, for the 9 months, you have a personal relief of 500,000. For the 9 months is 375,000. You have to proportionally take it. And for the employment relief, out of 700,000, it's 525,000. So you can claim it 375,000, 525,000 for your first 9 months. For the last 3 months, for your last quarter, it will be under your new tax structure. So out of the 3 million for the for a quarter is 750,000, and out of 1.2 million is 300,000 per quarter. But for 300,000, if you have expenses, you can claim. But you need to have, keep in mind, you have to have the relevant source documents. So this is how you can claim your tax relief for year of assessment 2019-20. So you need to be very careful for the 9 months and 3 months, because you need to, IRD have already issued the guidelines. You need to properly study it and do your calculation, or otherwise get the help of your personal tax consultant. And then for the year of assessment 2020, as I explained earlier, you are now eligible for tax relief of 3 million plus 1.2 million for the qualifying payments. So 1.2 million means you need to have incurred expenses under that 5 items, and also you need to have the source document related to that expenses. So it's a pretty big relief that given by the department and the government. I think you can make use of that relief in the future. And what is our new income tax rates effective from the 1st of January 2020. So as I explained you, the personal tax relief is 3 million. Previous tax relief, personal tax relief was 500,000. Now it has increased up to 300,000. Previously, we had a employment relief of 700,000. Now it is no more there because we don't have pay. We don't have pay. So employment relief is no more there, but the personal relief 500,000 has increased up to 300,000 from the 1st of January 2020. And the qualifying payment 1.2 million, as I explained you. So after deducting all your tax relief, whatever the taxable income will be taxed from this tax rate. For the first 3 million is 6%, for the second 3 million is 12%, and whatever the balance is 18%. So maximum up to 18% you'll be taxed under the individual income tax calculation. So previously it was 24%. Now it has reduced up to 18%. But there is something we need to understand. So I will explain you with the calculation in my next presentation slides. So even though I think even though we have a good understanding on the tax calculations, we need to be careful on tax compliance as well, because if you fail to do so, there are a lot of penalties has been introduced to the income tax act. And even now they have included, if you evading your taxes, it is taken as a criminal offense as well. You can go up to maximum 5 years of imprisonment. So you have to be very serious in terms of compliance. So that's why I'm always telling that you need to have very thorough understanding on the compliance. It means on which dates you need to make the payments, on which date you need to make the you need to submit the tax returns. So normally, if I explain you that if you have an income tax file for the year of assessment 2020-21, so our first quarter of the 2020-21 already ended yesterday. From the 30th June, you already ended the first quarter of 2020-21. And you will have another 45 days to make the first payment for the first quarter before the 15th of August. So if you, after the end of the quarter, every quarter, you will get another 45 days to make your calculation and make the payment to the department. And then whatever the tax, the income tax return need to be submitted or no before the 30th November 2000, in the following year, in 2021. Likewise, so you need to be very cautious on the compliance, because if you fail to register or notify the changes in taxpayers information, there will be a minimum sort of a maximum of the 50,000 penalty will be imposed. Even if you, I think recently the department issued a notice in the beginning of the June that if you have not opened up your TIN numbers, you had to actually open up the TIN numbers before the 30th of June. So I believe, I think most of the people has opened up the TIN numbers, but if you have not, we have to do it quickly, because we don't know whether the department will impose the 50,000 after the 30th June. So if you do any late tax filing of tax returns, it is the grade of the 5% of the taxes plus 1% interest each month, or 50,000 or 10,000 for each month, whatever the greater, subject to the maximum of 400,000. And failure to pay all or part of the installment is actually 10 to 20% of unpaid taxes plus 1.5% interest per month compounded monthly. Negligence or fraudulent act, 25% of underpayment subject to other conditions. And if you're evading your taxation, it will be a criminal offense, maximum up to 5% years of imprisonment. So it is better to get understanding on the penalties, because the penalties will be imposed automatically in the RAMI system. I think everybody knows now the tax authorities are using a system called RAMIs. So when you ever delay your payment within 1 minute, okay, just after the 30th of 15th of August, if you're passing 1 minute after the midnight, the penalties will be imposed. That's the nature of the current system. So I think you have to be very cautious that you need to comply with the rules and regulation of the IRD, that you need to calculate your computations, and you need to make the payment on time, and then you have to submit the return on time. Otherwise, you will be getting these penalties in the future. So you have to be careful. I think Nobody wants to pay penalties apart from your taxes. Okay, so then we will move forward with the second illustration. So after the tax amendments, what is the impact? Now this is, you have to carefully, you need to understand this. So if I go with the illustration, Mr. A is a CFO of a company. He received the following income during the year of assessment 2019-20. The employment income 4.3, interest income is there, dividend income is there, rent income, and also he has incurred educational expenses of 500,000. So let me check how the calculation is taken place. So if you check, there is a two columns. One is prior to the 1st of January under the previous calculation, and after the 1st of January 2020 with the recent tax amendments. Okay, so previously you already know that interest and dividend income is not part of as well income. If the bank has deducted 5%, it is not taken as your part of as well income. And if the dividend, it's the same. So in the employment income, yes, in the board calculation, they have taken 4.3 million. In the investment income, so previously it was final tax. Because of that, it is not taken as your part of assessable income. But now no more withholding tax. So it is not the final tax. So now it has become a part of assessable income. So previous, now you can see 5.6 has been added. And the dividend income was the same. Now it is part of your assessable income. There is no any final taxation, so it will be added. And then rent income. So under the previous tax structure, your assessable income was 4.8 million. Now under the new tax income tax calculation, it is 10.5 million. So you can understand what is the difference in terms of the recent tax changes. Even though the payee was not there, now it is come up with a new name called API. Even though the withholding is not there, it has taken now brought back again with a different name. So now your taxable income has increased. So you can understand the difference. How you are going to calculate? So 4.3 and 10 million. So when it comes to deduction, previously tax, you had an employment relief of 700,000. So as I explained you, before the 1st of January, you had the 700,000. But 1st of January, you don't get the 700,000 tax relief. And rent relief is there, 25% of your rent. It is 112,000. It was there, and at the under the new tax changes, it is the same. But in the, and also the personal relief. Before I go into expenditure relief, I will go to the personal relief. Personal relief is previously 500,000, and now it is 3 million. Now it is 3 million. And expenditure relief is that qualifying payment. It means in that previous slide, you can understand he has made expenses for his education. So that 500,000 he can claim from the calculation. So previously, under previous calculation, he can claim 1.3 million. Now under the new tax structure, he can claim 4.6 million. So even though there's a 4.6 million, still your taxable income under the previous one, 3.5 million, under the new tax structure, it's 6.9 million. So if you incorporate the new tax rates, new tax table, you can understand how the income tax liability has increased under the new income tax law. So under the previous tax structure, it is 485,400, but with the new tax changes, it has goes up to 715,000. So you can understand. So, but if you really closely review this calculation, what is the main reason behind this? Why the tax has been increased? Okay, because of the mainly due to that withholding tax removal. Because earlier it was a final tax. I give you one example. Interest income 5.6 million. Even you make 5.6 million interest income, even you make a 10 million interest income, the interest rate was 5%. It was the same. But here, now it is taken as part of your assessable income. Once you add up employment income, interest income, and dividend income, and whatever the rent income, the tax base is going to be increased. And then if you go to that tax structure, tax table, you can jump into 6%, whatever the balance is going to 12% and 80%. So whoever actually paid 5% for their interest income previously, now will end up in paying 18% under the new income tax changes. So this is a main change. Whoever have interest income and dividend income, comparatively larger income compared to the employment income, they will be affected actually they will have to pay more taxes in the future. So I believe that you can understand what is the difference between the previous tax structure and whatever the changes happen. Based on that, you can actually manage your wealth likewise, and you can get understanding what sort of investment we are required to do. So I think by introducing this kind of tax structure, yes, definitely government is expecting more income tax revenue in the future. Actually, will not be happening from the financial year 2019-20, but it will be happen from the year of assessment 2021. So then people, I think in the future, people need to understand that they will have to reevaluate their investment opportunities, and also whether they are going to put it to a fixed deposit, or otherwise they are going to put it to an investment in such starting up their own businesses and investing and make a revenue. Because when you have a business income, you can deduct whatever the expenses related to that business income. So because of that, I think people need to a lot of individuals are required to think about their investments, investment portfolios when compared to the new tax recent changes. So I think you have understand the difference between these two methods. Then I will go ahead with the third illustration. In the third illustration, I will explain you, if you have only employment income, what is the benefit of selecting option 1 and option 2 under the APIT, advanced personal income tax? So in the option 1, you have given the consent to the employer to deduct the tax and pay to the department. Option 2 is you open up your own income tax file and pay the taxes on quarterly basis. So what's the difference? We will understand from this calculation. So Mr. A is a CFO of a company Q. His employment income for the year of assessment is 4.2 million. He has spent 500,000 for his children education and 250,000 for their medical expenses. Okay, so that children education and the medical expenses will be taken under the tax relief of 1.2 million. And then if you have chosen option 2, where you are going to open up your own income tax, that you can claim your qualified payment of 1.2 million. So employment income is 4.2 million. Your tax relief is 750,000. Expenditure relief is 750,000. That is 500,000 and 250,000. So 750,000 you have claimed, and your personal relief is 3 million. Your taxable income is 450,000. So for that 450,000, your tax is 27,000. But if you select option 1, where you have given the consent to your employer to deduct the tax from your salary, as I told you earlier, in that calculation, the IRD has not made a provision for that qualified payment of 1.2 million. So because employer can't get all the information from the employees if they have done that expenses. Because of that, they have not incorporated that 1.2 into their calculation. So what will happen is, the employer will not take the expenditure relief into the consideration. He will not, it will be 0, but he will deduct the 3 million, 1.2, then the taxable income will be 1.2 million. So then if the employee is going to deduct this from your salary at the end of the year, you can compare that he has deducted 72,000. But if you have open up your own income tax file, you ended up with paying 27,000 only. So if you select option 1, at the time you are going to submit your income tax return, there will be a refund in the income tax file. So it's up to you whether you want to go with the option 1, option 2, or whether you want to give that consent and pay something extra to the government, and end of the day you will be claiming for the refund in the next year. So it's up to you. And also if you select option 2, you will have to pay your taxes on quarterly basis. So if you have, during this kind of a pandemic situation, if you have any working capital issues, you can manage it through that as well. You don't have to deduct on a monthly basis. You just have to deduct it on quarterly. You have to calculate on quarterly basis, and you will get another 45 days. And after the end of the quarter, you will get another 45 days to pay the taxes to the department. So it's up to you whether you can, whether you want to go ahead with option 1 or option 2. But we always recommending our customers or our clients is always better to open up your own income tax file, do your calculation, and pay the taxes on quarterly basis. That will be more feasible for you. But if you select option 1, you will be ending up paying more taxes. So I think if somebody asks, okay, it means compared to the previous tax structure, under the new tax structure, it means are we going to pay more taxes? Yes, you will going to pay more taxes in the future. So I think that is one of the questions a lot of the people had. They thought after the abolishment of the pay, you'll be paying more less taxes in the future. But if you have more revenue more than 250,000 per month, it means if you have more interest income, and if you have more dividend income, likewise, we'll be ending up paying more taxes from next year of assessment. So I believe that I have covered up all the area, and I think you have got an understanding what was there previously and what is happening right now, and also what is the impact on your tax liability and your cash flows as well, and how you have to think about your investment portfolio, and how to adjust it in the future. So thank you very much for listening to me, and apologies for any disruptions happened due to the lack of communication connectivity. So, and I'd like to hand over back to the Sashmini to take it forward.
Thanks, Rajitha. This is Suresh. So we have a question, hand raised by Afzal. I'll patch him through to directly address his question.
Yeah, please.
Afzal? Afzal, are you able to hear us?
I think Afzal has in the question he has raised, if rent income categorized as investment income still can continue as same. I'm not quite sure clear that question,
Afzal,
Suresh.
we are not able to hear you. So in the meantime, Rajitha, we have another question from Harshana here.
Yeah.
Which is, when you say with the new tax structure, we have to pay more tax, does it mean everyone or only those with very high incomes?
Yes. If you really see that in my calculation, if you can see that whoever has, I think the revenue sources are can be employment income, interest income, and dividend income, and other sources. But if you have only employment income, your tax liability will be lesser. But if you have more revenue sources like interest income and dividend income, then I think you will be ending up paying taxes in the future. But if you have only employment income, the tax impact will be lower.
Understood. I hope, Harshana, that answered your question. If you have any other questions, you can key it in on the Q&A. Yes, we do. We do have another one from Bhavanta. How can you distinguish medical insurance from life insurance as both are embedded in a single product?
Uh, yes, there's a one question. One thing we need to understand that IRD, even though they have disclosed these 5 line items, expenses, they have not defined those expenses yet. So for your question, I think whatever as you explained, the life and medical is embedded in the one policy. Yes, you can claim it as at today. You can claim it from the under the new tax relief. But once the IRD issued the guidelines, it can change. Up to now, yes, since there is no guidelines, it can be claimed.
Right. I hope that answers Bhavanta's question. Uh, Afsal, unfortunately, we are unable to hear you. If you're able to type in your questions, perhaps we can address it then.
Okay, Harshana has asked just one more. Can you just show the tax year time period you showed in the beginning? Okay, can I show it, Suresh?
Yes, Rajita, please go ahead.
I believe, is this the slide you are referring to, Harshana? I believe this is the slide. Okay, is there any questions I would like to answer?
Okay, great. Unfortunately, well, the last one I had was from Afsal, but
Okay, there's another one. I think Absal has asked another question, Suresh.
with regards to
Approved?
approved pension fund, whether it
Yeah.
can be included in EPF.
No. EPF, ETF is not taken as a approved pension fund.
Okay. Um, guess that's all we have for today. So perhaps if you have any follow-up questions, you can post it on our social media platform, and we'd be more than happy to get you in touch with Rajitha, and he'd be more than happy to assist you with any other advice and take it from there. So in closing,
There's a one question, Suresh, came again.
okay.
What about life insurance pension funds? When it comes to approved pension fund, one thing you need to understand, it needs to be approved by the Commission General of India Revenue. It needs to be approved by the Commission General of India Revenue. So then we need to double check with your life insurer whether those pension funds are approved. If it is approved only, you can claim it from your computation. So that's something we need to understand. I know there are a lot of pension funds are available with the insurers. I think now a lot of the insurers has put it to the Commission General of India Revenue for it to be approved. If it is approved, yes, you can claim it. If not, you cannot.
Right. All right. So on that note, we will wrap up the session. We went slightly overboard due to the technical delay we had earlier. But once again, Rajitha, thank you so much for your time. We really appreciate it. And that was a very insightful session. And I'm sure most of the folks will look forward to the published version, which will come online on our YouTube channel. So for those of the folks who actually missed out, you can tune into our YouTube page, and then we will have this session up there. And stay tuned for more insightful events coming through Hatch Online. And once again, thank you, Rajitha, for your time, and look forward to perhaps catching you up on a live event at the Hatch Auditorium.
Thank you very much, Suresh. Thank you very much for the opportunity. And also thank you very much all the viewers today join with us. And if you have any question, if you can send it to the Hatch, I would love to answer for those questions as well in the future.
Great. Thank you. So with that, good night, everyone. Enjoy the rest of your day.
Good night.